14 of 21 series are aligned with stagflation mild this morning. That is a moderate level of systematic agreement across the macro set under our framework. The current macro regime is stagflation mild, with a confirmation score of 14 out of 21. In regime terms, the engine is observing a macro regime, where growth momentum is decelerating at minus 0.5696, while inflation momentum is accelerating at plus 0.0081. 1. That combination is what our framework characterizes as mild stagflation. The math reads softening activity alongside gently building price pressures instead of outright contraction or disinflation. Coherence score is moderate, paired with the confirmation score of 14 out of 21 and a historical persistence rate of roughly 41% over 3-month windows in comparable setups. 1. Compared to last week's configuration, the confirmation count is unchanged at 14 series, but the volatility complex has shifted into a more elevated state, and fear and greed has slid deeper into extreme fear. Historically, environments like this have felt choppy across markets in our sample. Sector-differentiated equity behavior, uneven bond returns, and more importance placed on cross-asset dispersion than on index-level trends. 1, 3, 7. On the yield side, the rate complex sits in a relatively calm zone. Move is near 65.39, down 7.46%, and around the 8th percentile of its 2-year range, while the 30-year Treasury future is almost flat at 114.121. The framework tags this as yellow momentum for rates, low volatility with hesitant price action in duration. In our framework's reading of comparable periods, this roughly coincided with alternating steepening and flattening episodes in yield curves within the subsequent quarter. An observation under our methodology, not a forecast. Labor conditions are sampled through PAMs and claims metrics. PAMs is in the engine's red momentum band, reflecting softening employment growth, while initial jobless claims, ICSA, also register red as they trend higher within our rate of change filters. 1. In our framework's reading of comparable periods, this roughly coincided with slower aggregate demand growth and more defensive sector leadership emerging over 1 to 3 months. An observation under our methodology, not a forecast. 9 credit is assessed through spreads and equity-linked financials. The financial sector ETF sits at 53.45, down 0.50%, while credit spreads in our composite hold in a neutral zone. 1. The engine reads this as yellow momentum for credit, neither tight enough to signal strong risk appetite nor wide enough to mark stress. In our framework's reading of comparable periods, this roughly coincided with modest dispersion inside financials and a focus on quality balance sheets over the following quarter. An observation under our methodology, not a forecast. 7. For the fourth signal, we look at equity sector rotation. Industrials are up 2.17%, materials up 1.33%, and healthcare up 1.49%, while technology and energy are positive but less dominant. 1. The framework classifies this as green momentum for cyclicals outside pure tech, a definition based on relative performance spreads across sectors. In our framework's reading of comparable periods, this roughly coincided with more balanced index behavior and leadership rotating across sectors within 1 to 2 months. An observation under our methodology, not a forecast. 6. If the 10-year yield crosses 4.45% and holds for 5 consecutive sessions. In our framework's reading, inflation composite acceleration appeared in roughly 9 of 11 comparable conditions, a historical characterization, not a forecast. 1. Under a stagflationary regime context, such moves have historically marked firmer inflation math and more pressure on duration in our sample. If fear and greed drops below 15 and holds for 5 consecutive sessions, in our framework's reading, deterioration in the regime confirmation score appeared in roughly 7 of 9 comparable conditions, a historical characterization, not a forecast. 1. Within this macro regime, our historical work associates that configuration with more defensive cross-asset patterns and weaker alignment in the 21 series, purely as past observations. The map is live. These conditions are being monitored daily across all 21 series. Atlas is the automated, rules-based engine inside given analytics. It does two things in parallel. First, it publishes a view of the macro environment, the regime, the confirmation score, and the historical base rates we just covered. Second, it runs a fixed four-layer mathematical framework: price structure, rate of change, risk regime, and market participation, across 407 liquid symbols every trading day. When all four layers agree on a symbol, Atlas records it as an upside-aligned or downside-aligned condition under the framework, a reading of how the four layers line up, not a trade. These are time-stamped model readings logged for members to study. The environment view and the condition log sit side by side inside Atlas. They are separate outputs. The regime does not pick the symbols. The four layers do. Members use Atlas to study how the framework has recorded conditions across prior environments, as historical behavior, not as trade selection. Atlas runs the framework. You study the outputs and environment. You decide what to do next. May, potential, and educational all describe how Atlas is positioned. It characterizes historical math, not future outcomes. The morning brief is the public surface. The live Atlas dashboard shows the full 21 series regime map, today's mathematical conditions across 407 symbols, and the historical archive side by side. Members study the environment and the Atlas outputs each morning. If you want to track this alongside us, the live view is at givenanalytics.com.